Okay, Don Durrett, Gold Stock Data. This is the final part. This is part three. So the last one took about 45 minutes. I think this one might go a little faster than that, hopefully. Investment strategies, buy and hold. So I talked about this back in part two. Talked about how it's a risky strategy because um, trading you're not these are very volatile stocks. So if you buy and hold, it's not unusual to for stocks to crash. Is In fact, it's quite common on an annual basis for gold and silver miners to have some type of a sell-off during the year. If you look historically, so if you're buy and hold, it's inevitable that you're going to go through periods of significant paper losses in your entire portfolio. So buy and hold it's a risky strategy. That's why I try to keep my cost bases down because I feel that the quality companies won't get as hit, is are more likely to come back. But it is risky. That's where the trading, if you do say 25 to 30 stocks and you're trading them and you're monitoring them and you're basically not allowing them to crash on you. Maybe you have some trailing stops on them, or um, it it allows you to hedge to a certain extent. Whereas buy and hold, it's much more difficult to hedge. Um, so one of the ways that I do that, I talked about my portfolio, my pyramid approach, where I try to keep, a strong base. That's one of the ways that you can diversify from this volatility. Okay, so using stops. So this is perhaps the ideal investment strategy for mining stocks because of their volatility. And it requires a lot of hands-on effort, a lot of monitoring, a lot of buying and selling. So you basically have to be a trader. So if you're using stops, if you have 30 stocks out there and you've basically put a stop, I don't know what you're going to use, 25, 30, 35% on them. I mean, it's possible to get stopped out. It's one of the reasons why I don't like to use stops, especially as many stocks as I have. I just don't want to get stopped out. But it is an ideal way to hedge your fund. And if you're trading, again, I think that's probably the ideal way to really to do mining stocks. But you have to be a good picker. You got to pick the right ones because it's hard to, if you're going to only have 25 or 30 stocks, it's going to be difficult to pick the big winners. Um, you have to determine your stop loss for each stock and be prepared for significant capital gains or losses whenever you have a stop loss, because that's going to be an event once, if you're going to trigger a sell stop, that's going to trigger a capital loss, capital gain situation. So you got to be aware of that. Using trailing stops can be very effective and lead to large gains because you effectively lock in gains once a stock trends higher. So I'm actually going to talk about trailing stops when I get to my exit strategy. But if you use trailing stops and let's say you have 25 to 30 stocks and let's say 10 of them are basically doing fantastically well, they're all up like 100%, then you can have like a 50% trailing loss on those and still have 50% gains locked in. It's a really good situation, if you will. It's kind of the ideal thing that you want if you're trading. And who knows how far up you can follow that stock or let it trend until it stops out. Okay, so part two. So cut your losses. So this is where you're using that trailing stop, and so whenever a stock trades down, it's going to get stopped out, and you have to decide if you want to get back into that stock, or you basically say, nope, that stock didn't work. I'm going to go find winners. I only want winners in my portfolio. That's going to, some stocks you'll bring back in, some stocks you won't. Pressure winners. So this is when a stock is working. So let's say a stock, you put money in a stock and it goes up 25%. and you basically you double your cost basis into it. It's working, I'm going to press it. And then if it's a dog, it's like, I'm going to sell it. So let's say, it goes down, you might have basically you say, I'm only going to put a 10% stop loss on this company because I don't, maybe I'll keep it or maybe I'll just sell it, kind of thing. Taking your profits. So this is kind of an ongoing thing. You have to determine, at what point do I want to take profits in companies? Do I want to just let them always run? Do I want to have an exit point for every stock? It's good to have exit points for your winners. So once you identify a winner, then you can identify an exit point, and the exit point can be anywhere from 100% to 1,000%. So you have to just decide, okay, this is, if I'm up 100%, you have to decide how much you're going to take off the table. You're going to sell the whole thing, take half of it off, a third of it off, or you're going to let it run and then wait till it gets to 200% and take half of it off or something like that. You have to decide, what are your exit points for your winners. And you can also have exit points for losers as well. So it's up to you. It's always good to keep part of a winner. I talk about this in my exit strategy. So keeping 25 or 50% and letting that ride and then using a trailing stop, you're basically locking in profits that way. It's a good methodology. Market timing. So this is, a lot of this is understanding, what the overall market is doing. Like right now, it's a good time to be patient, as far as market timing goes, because we're currently in a correction. And the market timing is to wait until we correct and get in at the bottom. We're probably not at a bottom right now, but once gold gets over, say 1950, then if you're going to do market timing, that's a really good time to get in, because after we get to over 1950, we're probably going to go to 2100. So those timing the market to get these good entry points is really important, especially if you're a trader, because then you can, immediately, if you time it right, you can immediately go up, 20, 30, 50%. And then that allows you to put that trailing stop in there to prevent significant losses. The more gains you have in a stock, the more, profit you're going to lock in, or lack of a loss you're going to lock in. Data that is good for gold, silver prices. Okay, so when you're looking at the overall market, when you're trying to time it, you want to look at the economic numbers. So what's good, weak economic numbers like the PMIs, jobs, stuff like that. Weak economic numbers are always good for gold because it creates uncertainty. Weak dollar, they always trade inversely. Sometimes they trade together, but by and large, on average, they trade opposite each other. Low interest rates. So this one's kind of interesting. So negative real rates are always good for gold. And so when you get low rates, then you tend to get negative real rates because inflation is higher than interest rates. But conversely, we're now in a situation where high interest rates are actually good for gold. But there's kind of an in-between. So the in-between is not good for gold. So let's say the 10-year, if we get to like 1.75, well, actually, right now it's getting to the point where the 10-year, if it goes down, you have negative rates, which is good for gold. And if it goes up, you create uncertainty. So it's like interest rates are benefiting gold all around at the moment. I don't know how long that's going to last, though. But negative real rates are always really good for gold. High inflation, that's good for gold, and then uncertainty. So those are kind of things you want to look for market timing. It is important that you follow business news and various data points. So this is all about market. If you're going to do market timing, you want to really have a really good understanding of what the gold and silver price has done, not just this week, but last year, the last 5 years. You want to follow it on a daily basis. You just want to have a real good feel for the gold and silver price. The S&P 500 and the Dow indexes, I think you should follow those on a daily basis. They're going to help you to understand the gold market, GDP numbers, unemployment numbers, sector numbers. So we got housing, autos, technology, consumer spending, healthcare, all these sectors. The reason why you want to follow them is because when they're weak, that creates uncertainty, creates strength in gold. When they're strong, that's when you get what we have right now, which is a risk off trade. When you get a risk off trade, nobody cares about gold. Everybody, if we have a risk off trade, everybody's going to put their money into the stock market. It's like, oh, there's no risk in the stock market. I can buy whatever I want to buy. I'm going to make money. So you got to be careful. Watch those sectors, and they'll give you a feel for just how much of a risk off trade we actually have at the moment. And then the trade numbers. The trade numbers kind of go hand in hand with these sectors. The PMI numbers, I always follow those, and your income growth. PMI is your manufacturing numbers and even your service sector. Those give you a really good, those are like indexes for the overall economy. It's kind of the heartbeat. The gold silver ratio. Okay, so we're at exit strategy. So this is exit strategy number 1. The GSR, the gold silver ratio, it's going to be a really good indicator of when the bull market is over. So the GSR historically, back in the 1800s, was about 16, and gold is mined about 10 to 1. I hear some people say 9 to 1, some people say 12 to 1, 8 to 1, but it's about 10 to 1. And so, but silver's never garnered, a 10 to 1 valuation versus gold. Gold gets a little bit of a premium, if you will, so 16 to 1. But currently it's about 70, somewhere in there. And so it reached 122 last year. It's the all-time high. Never got that high before. Kind of got out of control. In 2011, it dropped down to 39. And in 1981, it went to 17. So I think that once the GSR gets down, say, below 30, you have to start thinking in terms of this bull market is getting, it's getting close to ending, if you will. So the GSR is something to look at. Now, the GSR isn't my favorite indicator per se, but it's a good one, because we know that in 1981, it got to 17, and in 2011, it got to 39. We also know that in 2011, the bull market was very short. So it probably would have got to 30 is my guess, if the bull market would have lasted a little bit longer. So this bull market, I think 30 is really when once we get around 30, that's when you start thinking in terms, this could end. That's really, it's time to take some profits. And I would say that the bull market, right here I say that, has begun when it drops below 50 and is ending when it exceeds 50. So it doesn't make a lot of sense, Don. You just said when it ends 30, it's going to be exiting. So 30 is, yeah, we're kind of in bull market territory below 50, but once it gets down to 30, I think that's about when it's going to end. Okay, the Dow Gold ratio. This one is another going to be another good indicator for when it's getting frothy. So I don't think that the bull market's really going to get frothy until like 35, 30 GSR. And then for gold Dow ratio, I think 3 is when it's going to really get frothy, and 2 is going to be a kind of a good exit point. So if we look at the Dow Gold ratio back in 1981, it was 1. 850 gold, 850 Dow, 1 to 1. Some people think we might do that again. I don't. I think we're probably going to go to 2 to 1. And I think once we get to 3 to 1, that's basically going to start indicating that this bull market is probably getting ready to end. And if we get a lot of inflation and the stock market goes crazy, we're not going to see this, of course. But I think that the stock market's going to come back down, and I think we will see this type of a scenario. So here's some projected possible scenarios. We have the Dow at 20,000 and gold at 10,000. That would be a 2 to 1. Remember, I said 2 to 1 is like, that's about when you want to get out. And then we have 15,000 on the Dow and 7,500 on gold, and then 10,000, 5,000. So something in here. I think that I don't know if it'll crash all the way to 10. I don't know if we're going to hit any of these, but these are just numbers to take a look at. Um, uh, yeah, I'm not sure, but you know, the Dow Gold ratio is another indicator for exiting. Okay, so this is my plan, my exit strategy. So as the price of silver goes higher, so sell silver stocks as silver prices rise. So for every $10 that silver rises above 50, I'm going to look for stocks to sell. Um, I'm overweight in Mexico, and so I want to get out of silver stocks. So I'm going to be looking for silver stocks to get out of, and so I want to sell at least 50% of my silver stocks by $100 silver. Now this is conservative. I'll probably be more aggressive than this. I might get out of 50% by $75, $180 silver, but this is my conservative. I plan to be out of 50% of my silver stocks by $100 silver. And once silver goes even higher, say 150, I'll probably be 80% out. So as silver goes up, so I want to aggressively, I kind of aggressively get out of silver stocks. I think this is a once in a lifetime market. I don't want to hold this for another 10 years. I think this is it. This is the bull market. I think this is when we're going to see silver go to 150, 200. So sell gold stocks as gold prices rise. So I'm going to be less aggressive here than silver. And the reason why is because I just think that silver has more risk than gold. Because it's a strategic metal, and I just think that governments are not going to allow really, really high prices and shortages. I mean, that's why I said I'll probably be even more aggressive than this. It just depends what kind of shortages we have, but I might have to be more aggressive on silver. It depends. But gold, I'm going to be less aggressive. I'll be more patient with my gold stocks. So I'm only going to sell about 25% of my gold stocks by 2,500. So that means I'm going to let them, 75% of them ride all the way to, close to 3,000. I'll be very patient with my gold stocks because I think gold will go to 3,000. And from 3,000 to 3,500, that's when I'll be really exiting. That's when I'll be aggressively getting out of gold stocks. But I really want to like to ride it up to 3,000. So other part of my exit plan is keeping 25% of my quality producers. Now, what I mean by keeping 25% is not keeping the entire stocks. That means I'm going to sell 75% of an individual stock and keep 25% of the stock. Somebody recommended this to me, and it makes a lot of sense. He said that you never know how high gold and silver is going to go. That final 25%, you could have more gains on that final 25% than the first 75%. That makes a lot of sense to me. So I'm going to, sell 70. I'm only going to do this on the quality producers. So, and then I'm going to basically let them ride to the top. So I'm going to sell 75% and then put in a trailing stop of say 25% and then let the stocks stop out on their own. So if they're quality stocks, they really shouldn't sell down 25% unless the bull market is over. But it's possible. I mean, a 25% sell-off is very possible in this very volatile market. But I'm going to try that definitely with a few stocks. I'm going to see how I'm going to let them ride. Okay, analyzing drill holes. So I have a separate video called Analyzing Drill Holes. It's 20 minutes long that goes over each of these slides. But I will pause a little bit here so you can actually pause your video and read these if you want to. I'm not going to go over them now, but you can read them yourself, pause and read them. But then you can watch the 20-minute how to analyze drill holes where I go over each of these slides. There's 6 slides and 20 minutes. So it's about 3 minutes per slide. And this is the last slide here. And then I have a reference chart on the next slide. Nope, I'm sorry, this is the 6th one. I have one more slide, and the final slide is the reference chart. And the reference chart, here it is. This reference chart is not on, I created this reference chart after I did the video. Somebody told me to create the reference chart. So we will go over the reference chart here. And this reference chart encapsulates the other 6 charts. Basically, everything on the 6 charts is encapsulated in this reference chart. So this reference chart is very, very nice. So when you do a drill hole, it really comprises 2 data points. The first one is your grams per ton times your width. So you multiply these up. So let's say that we have a grams per ton of 5, and then we have a width of 10. So you multiply those, you get 50. So that would be a good drill hole. But you also, so we had a grams per ton of 5. So we come down here and we look at, let's say it was an underground mine and it was 5. So we come here, it's basically, it's in the marginal and good. I would put it in the good, 5 to 10. So this is 425, so 4 to 5. So it's kind of, maybe I should have put 6 to 10 in the good. So you have to look at both data points. You have to look at the, multiply these out, find out if it's a, really good, excellent, stellar, and then you have to look in here and see if it, is it in the good and the high grade. So these are the grades right here, very low. These are, so instance, gold underground, very low grade is 2 to 3 grams. Gold surface is 0.3 to 0.5. And then the same as silver grade, underground and surface is basically the same. There's not a lot of difference as far as very low, high, because we tend to find most of your high grade underground is very high, 240, but you find a lot of surface gold and underground basically the same. That's why there's not there's not enough difference to really create a separate values. Now, the one thing that I want to talk about, this chart and these values are kind of a simple way to do it, but it works. They're a good rule of thumbs. And they help you. The one thing that they help you a lot of is these low grades, very low grades. You know, okay, it's not great, right? And then the other thing that helps you is if it's not a good drill hole. The one thing I don't have on here is marginal. So I probably could have had another row for marginal, and marginal would be say 35 to 50, and then marginal here would be like 350 to 500. And then anything below those would be bad. It's just a bad drill hole. So you can imagine, okay, this is good. If it's good, then, kind of close to good would be marginal, right? So you can kind of go up to 35 or 350 would be kind of marginal. Anything below that, pretty bad drill hole, right? So I don't have the marginal in here, so I need to kind of explain that. And then stellar, we see a lot of stellar silver mining stocks, but you never see a company mine 5,000 grams per ton. I mean, I think 800 grams per ton is about as high as you see anybody. I've never seen anybody mine 1,000 grams. So even if they have a stellar drill hole, the average is going to be less than 1,000. So if somebody says so if you see a stellar hole at like 10,000, 20,000, 30,000, I just round it back down to 5,000, because anything above 5,000 you can round back to 5,000, because nobody mines 5,000. Like I said, 800, 900 grams per ton is about as high as you see. In the past, historically they did, but there isn't any more mines that are like that, or like pure gold, pure silver, if you will. And so and I think that pretty much covers this whole analysis chart. But this chart will be as a reference, as a rule of thumb. It'll be very valuable for you. It'll really, really useful. Okay, gold stock data ratings. So these are the ratings, my upside and downside. So I've never I never did a video and explained these before. So I have, this is going to be useful too. I'm showing you how the ratings, how they fit in. But let me show you this first. So we have, the 1 is the lowest rating, right? So the lowest rating, it just means, that's the worst, right? It just means it's bad. Anything that's a 1 is really, really bad. And then it gets progressively better. So 1.5, 1 basically means avoid at all costs, anything that's a 1. 1.5, you can have majors can be 1.5s, potential 2-bagger. I'm not going to have a major as a 1. The worst rating for a major is going to be a 1.5, potential 2-bagger. And you know, a two bagger doesn't mean that it doubles in value. A two bagger means it went up 200%. One bagger is 100%. So this means it's going to go up 3 times, 3x. Two bagger, again, 200% return. And then we have a two, which is a potential three bagger. And then we have 2.5, a likely three bagger. And these are all based on, these are all producers, not necessarily producers, I take that back, can't say that because I use the same ratings um, I'm going to talk about that on the next chart. The reason why I have them yellow, green, and red, depending on the upside and downside. So this is a likely three bagger, 2.5, potential five bagger, likely five bagger, potential 10 bagger. Now, this is as high as I go. I haven't used the 4, 5, and the 5s yet. I might in the future. It's possible, but right now, I haven't used anything. So if you see something that says potential 10 bagger, that means potential 10 plus bagger. This really should be a plus, and this these should be pluses on potential fives. And you know, even they don't have pluses, but they definitely could, because I don't have anything from 6 to 9, right? There's nothing from 6 to 9. That means that these guys could definitely potentially be in there in that category. And I don't have anything greater than 10, so that could definitely, these could be 10 plus, right? So that's your upside. The upside is just your upside potential on your market cap growth. Downside potential. So the downside is going to be the risk reward. And this is a combination of all the factors that go into like the quality of the company. It's kind of your risk reward on a risk basis. So your downside is really talking about risk, but it's also including reward as well as part of that, this downside rating. It's a two-factor rating, and I felt that there's no way you can encapsulate risk inside of this. So I split it apart. And so a 1 is something you avoid at all costs. I mentioned that before. 1.5, the only time 1.5 really comes into play is if you have a 4. So if you have something that's a 4, then very poor risk, but you know, you still might analyze it. You're probably going to avoid it, but you know, you might take a look at it, because this 1.5 could turn into a 2, but that's the only time, right? 3, anything below this 1.5, forget about it, right? And then we have 2, poor risk reward. And the 2, the only time you're really going to look at 2 is again the 4. It's the only time you're going to look at 2. Otherwise, it's not worth it. All of these are not worth a 2. So the 2.5 really comes into play with just about everything except for the 1.5s. The 1.5, 2.5s become really marginal. You really want the 1.5.3s, and then the 3.5, and this is all, you know, very poor risk. And again, when I'm looking at the risk factors, I'm also I'm putting in. So you could have I'm trying to include the reward as well. It's like it's part of that downside rating. It's not just a risk number per se. So for instance, like right here, when I have 3 and I say good risk, good reward, what I mean by that is all the factors like the management. It's like it's you know, the grade, the properties, you know, the upside potential. That's just what it's going to do. But I'm looking at all these things, the location, and I'm looking at everything. So the location, you can think in terms even the properties themselves, and the the additional properties, the exploration potential, all of that kind of can go into you know, what I think it's going to do. I mean, the quality is what I'm trying to get at here. Is these do include risk. The risk reward is like, it's part of the risk, but it's also like part of the quality. For instance, when I say tremendous risk reward, I'm really talking about kind of the quality of everything, the quality of, you know, the management team, the quality of the deposit, the quality of the location, the quality of the upside potential, how the value it is. So we're looking at that. Those all kind of come into play here. Okay, so we have, I think, like 3 slides left, but it won't take much longer to finish this up. So here we have producers. So we have a chart, um, and we have, this is the upside rating, and then this is the downside rating. So on a producer, we only really want, these are the stocks that we want to invest in. So we have a 1.5, but it has a 3 or higher in the downside. That could be a good investment. You're talking about, it could lower, you're not going to get great upside, but I still have it as green because it can diversify your portfolio. And then a 2 and a 3 can also, um, a 3 bagger, the upside's a 3 bagger. This is, only a 1 to a 2 bagger. Might not be fantastic, but can diversify. And then year 2, a 2 and a 3. I mean, it's going to be a 3 bagger, but yeah, but it looks really good. And then once you get to 2.5, of course, and then I have, these two, I don't have anything, right? We're going to avoid these. And then if you have a 2 and a 2.5, that's yellow. So you have to kind of analyze it. Is it worth it? Maybe, maybe not. So anything in yellow needs to be analyzed. That's why I have a 4 and a 2. These are, you might want to analyze this. So these are the ones that are, marginal. And these are kind of the best. And these are the avoids, right? Poor. So we have the developer, and you can see they changed a little bit. So on the developers, I only have 3 that are green, right? 3, 3, 325, 352, or 33, 353, and 4. These are the upside and these are the downside. Those are your greens. These can all be analyzed. And then we have exploration. And I actually have 3 or higher. So these are all ignores. So this is your color coded. Gives you an idea of how to use the upside downside ratings to get an idea of, red, yellow, green. Okay. Ratings. Category. Okay, so this is the matrix that I just had, this guy here, using risk analysis. So what is the risk analysis? So in addition to your upside downside, you also have a risk level. And the risk level is medium, high, or extreme. I don't use low anymore because there really isn't anything or I use moderate. There's no such thing as a low risk mining stock anymore. So I only use moderate, high, and extreme. So how does that come into play? Basically, you want to stay away from those in red, right? Be very careful with those in yellow, and spend most of your time analyzing those in green. Anything in yellow will be better if the company's risk level is moderate instead of high. So if the companies that are in those yellows, if I go back, so anything in yellow, let's say the risk level is moderate, and the risk level on these stocks can be moderate or high. So you need to look at that. And so that's where the risk level comes in. That's why the downside is, again, a risk reward, not just risk. And then I have an additional risk level, moderate, high. So anything that's in yellow, if it's yellow and high risk, then that makes it tougher to invest in. But if it's yellow and moderate, then it looks a little bit better. So if the downside is a 3, which is good, and the risk is moderate, you can surmise that the risk level is lower, on the lower end of the moderate spectrum. So what I mean is that I'm using moderate as my lowest risk, but that moderate spectrum is wide, right? You can have really good moderate risk or really bad moderate risk. And same with high. High can be really bad high or really good high. Well, it's kind of hard to have really good high, but you know what I mean. When I'm only using moderate, high, and extreme risk for each company, but there's a spectrum for each one. You can have on the left side, and this spectrum you have to figure out for yourself, really. The risk can be okay, this company, two companies can have high risk, but they're different, right? It's not extreme, but they're both high. They have different levels of high risk. One is kind of this end of the high spectrum, and the other one is at this end. One company can be very close to moderate, but not quite there. You know what I mean? So you need to take that into consideration. Basically, my point is this: is that these right here, these yellow ones, you don't really have to be too concerned when you have the green, but anything that's in yellow, you want to look and see, is it high, moderate, or extreme? There probably isn't too many that are extreme, but high and moderates. All right, this is the last slide, and we'll be done. So over the counter stocks. The one thing you will need to, this is in the US, the one thing you want to be cognizant of is there's 4 different types. And the 4 types are OT, CQX, and QB, which are basically very similar. These are stocks that the company provides the SEC with their financials. And so they tend to be fairly strong companies, but they're not big enough to be on the NASDAQ or Amex or New York Stock Exchange. Now your pink sheets, these are better than the gray market, but they're still not good because the companies are not providing their financials. And the gray market is the worst. These are companies that I don't know the definition between both of these, but they just get categorized as gray when they're like, I don't know how to exactly word this, but less reliable. So there's probably a better definition than that, but this is the least reliable. But you need to these both are problematic. You don't really, and these can have low liquidity, which can be a problem, and it can be tough to sell these sometimes. The one thing that I want to point out is that if a company is QX or QB, it's probably okay to buy them. But if it's a pink sheet or gray sheet, then you probably want to buy them on their native exchanges. There are companies that, when I say native, there are companies in the US that only trade OTC, and they should trade this. If it's in the US and they're doing pink sheet, that's not good. They should trade this. But if it's a foreign company and they're trading pink sheet or gray, then you want to trade on the foreign exchange, Australia, Toronto, or London. And you can do that through Interactive Brokers. And that's just going to give you pay a little bit more, but it's going to give you much better prices, better liquidity, and safer stock. You want to be careful with low volumes. So whenever you're going to buy an OTC company, go and check the volumes, check and see what type it is, one of the 4 types, and then check the volumes. You can check it here on this otcmarkets.com. And then I talk about only buying these stocks on their home exchanges if they're pink or gray. And that's it. That's into part 3. And everybody that watched all 3, I want to thank you. And if you watched all 3 and you're not a member of Gold Stock Data, just go to Gold Stock Data and click on the contact us, send me an email and say I'd like a free trial, and I'll give you a 2-week free trial. Again, Gold Stock Data, contact us, and just say, can I get a 2-week free trial? And that's it. Thanks for watching and much appreciated.